Hello, everyone. My name is Chris Shakowitz, and I am here from deferredtax.com to talk about the 1031 exchange. We at StartanExchange.com and deferredtax.com, we love the 1031 exchange. And why? Well, first off, it's very simple to understand. It's easy to use. It's inexpensive. And finally, it's a very effective tax deferral strategy. So Section 1031 of the IRS tax code provides this tax deferral strategy. So what is the strategy? Well, essentially, it lets you exchange real property for a like-kind real estate. You must use all the proceeds from the sale of the property for the purchase of a replacement property. And the like-kind real estate includes investment real property, not your primary residence. So that's any property that you're acting as an investor. You're not living in that property as a primary residence. So Section 1031 does not apply to the exchange of stocks, bonds, and mutual funds, et cetera. There are some exceptions there, but that's beyond the scope of this conversation. So what I want to do next is talk about a hypothetical property sale. So let's say somebody sold an investment property and they had a net gain of $1 million. Without the 1031 exchange, they go pay the taxes. They've got $686,000 left to invest. They do the 1031 exchange. They now have $1 million left to invest. A $314,000 cost in taxes versus a $1,000 cost if you did the 1031 exchange. So the beautiful thing about this strategy, if you step back and you look at it from a high level, is that essentially the US government is giving you a zero interest loan for $313,000 to go invest, to go make more money. Now, why does the government want to do that? Well, because they want you to keep investing in America, investing and growing the United States of America. That's why the 1031 exchange exists, to basically grow real estate, grow business, and grow wealth in the United States. So the benefits of the 1031 exchange are to keep your money working for you. Okay, so now what I want to do is to share a few tips about the 1031 exchange. So first off, it's almost never too late to initiate a 1031 exchange. An exchange can be initiated as long as the property has not closed escrow. However, if you're too late once the property's closed. So up until the date that the property's closing escrow, you can still start the 1031 exchange. In fact, we had a situation where some people were in New York City on like the 40th floor of this building. It's 4 p.m. They're all talking through a deal, and then the lawyer who was responsible for setting up the 1031 exchange forgot to do it. 4 p.m. on a Friday. Fortunately, one of those people called somebody that knows us. They called me. I got on the phone, and basically by 5 o'clock, we had a 1031 exchange started for that deal. So we can do these very quickly. The 1031 exchange does not delay the closing process. The closing process operates on its own timeline. You have to do the exchange before the close. And the sales agreement for the new replacement property could be signed before the old property is sold. This is called a reverse exchange. I'll go into this a little bit more at the end of the presentation, but it's outside the scope for the core presentation. But what it does in a nutshell is it lets you buy the new property, then sell the old property, which can be very useful in certain situations. All right, so what's the timeline of a 1031 exchange? Well, your 1031 exchange has a 180-day timeline. It begins the day that you close escrow. So when you sell your property, the clock starts ticking. You have 45 days to find a replacement property and 180 days to close on that replacement property. So what does that mean? Well, that means you started the 1031 exchange before the close of escrow on the property you sold. And then within 45 days, you've identified a property that you want to buy to replace the one that you sold. Then before day 180, you've actually gone through the transaction and closed escrow. That's basically a simple forward exchange. All right, so tip number 2, there are many types of real estate that qualify for the 1031 tax deferral. Basically, any property that's held for a business or investment qualifies for tax deferral via the 1031 exchange. It could be vacant land exchange for a duplex. It could be an office building exchange for a solar farm. You could have a warehouse that you're selling and you decide to go buy 3 condos, one on the Gulf, one on the East Coast, one on the West Coast. As long as those are investment properties, those are all valid transactions. So virtually any real estate asset other than a primary residence could potentially qualify for a 1031 exchange. And even your primary residence, there is a workaround we can do, but it takes a little time to do it. So just as a summary, what kinds of properties are out there? This is not an exhaustive list at all, by any means, but we have hospitality, which means hotels. You have multifamily, you have healthcare facilities, you have retail, self-storage, student housing. You could do vacant land. There's so many different properties. This is not a comprehensive list, but this gives you an idea that almost any type of building out there can qualify as long as you're buying it as an investment property. Okay, so tip number 3, understand the tax implications before you sell. Unfortunately, I run across this all too often where someone didn't realize the details and they went and did the transactions, and then they're looking at the tax bill saying, what happened? So it's important to understand the details. So the rules for the 1031 exchange are that the replacement property, the property you're selling, or sorry, the replacement property, the property you are buying, must be of equal or greater value to the relinquished property. The relinquished property is the property you're selling. The replacement property is the property that you're buying. They must be of equal or greater value. Both the equity and the mortgage must be replaced. You have 45 days to identify one or more replacement properties and 180 days to close on that replacement or that one or more replacement properties. So you can sell one property and buy multiple. You can sell multiple and buy one. So any cash remaining after the 1031 exchange process completes is called boot, and boot is capital gain, which means you pay capital gains taxes on it. All right, with those basics, let's go through the anatomy of a deal. So what does a 1031 exchange deal look like? So in this case, a real estate investor is selling a single family home for $2 million. This is net, so after closing costs and other expenses, they have a $2 million net. They had a purchase price of $400,000. They had some depreciation. They had no capital improvements. So the way this calculation works is you take your original basis, your purchase price of $400,000, you subtract depreciation, you add capital improvements, and then you take that total and subtract it from the sales price. So in this case, I'm going to take the depreciation of 100,000, subtract it from the purchase price of 400, which leaves 300,000 adjusted cost basis. I subtract that cost basis, which is my money, from the $2 million proceeds of the sale, and that leaves a $1.7 million capital gain. That is what you would pay the tax on if you did not do the 1031 exchange. So from a cash accounting, it's a little bit different because the cash, there's basically, you have tax accounting, you have cash accounting. From a cash accounting perspective, let's say I had a $400,000 mortgage. Well, that $400,000 mortgage leaves me with $1.6 million. However, my capital gain is $1.7 million. Now, I have less money than I'm paying the tax on. What's up with that? Well, your mortgage is bigger than your adjusted cost basis. So that's what caused this problem to happen. And this is a very common scenario. Now, at the end of the day, when you're doing the 1031 exchange, you need to take that 1.6 million, put it into the exchange process. You would put 1.6 million down on the new property you're buying, and then go get a mortgage for 400,000 or bring 400,000 in cash to the deal. So that's the way the exchange process works, and that's the way the capital gains works. The capital gains is not always the cash that you received on the close of escrow. Okay, so a few do's and don'ts for the 1031 exchange. So the first one is the new asset value. So essentially, the property you are buying has to be greater than or equal to the relinquished property, the property that you're selling. So if I sold a property for $2 million, I need to buy a property for $2 million or more. Now, the cash invested in the replacement property must always be greater than or equal to the cash received from the relinquished property. So in our previous example, $1.6 million, that $1.6 million must go into the new property. If it doesn't, anything that doesn't go there is called boot, and it basically gets taxed. And the debt on the replacement property has to be greater than or equal to the debt on the new property, or you could bring additional cash. So in our case, there was a $400,000 mortgage on the original property. So you could bring $200,000 cash and $200,000 in debt. plus the money from this 1.6 million from the 1031 exchange. And you can buy that $2 million new property essentially any of those combinations of ways. Now, in addition to this, there's a couple of rules that you need to understand. So one's called the three property rule. This one's pretty simple. And basically what it says, you can identify up to three properties as a replacement for the property that you sold. However, you must buy at least one of those properties. So this is called the three property rule. In addition, there's something called, well, just a second, on the three property rule, let me just share a little bit more. So you can identify up to three properties, and then you could say, I want to purchase one or all of those properties. Now, as long as your purchase is greater than the value of the property you sold, you're good. So if you want to identify three properties that are each worth more than $2 million in our example, you could do that, but you only have to buy one of them. Now, in addition, there's something called the 200% rule, and this is very important. If for some reason that you want to identify more than three properties, there's a catch. You can identify as many properties as you want, but if the combined value of all these properties is more than 200% of the relinquished property, the property you sold, then you must buy 95% of those properties. Now, this rule usually applies to somebody who's maybe selling a large office building and they're buying 100, single family homes, something along those lines. Usually it doesn't apply to the average investor who's selling one property and buying one property. But this was very important. That 200% rule essentially says that if what you're identifying is more than 200% and it's more than three properties, you have to buy 95% of those properties. So I always tell investors, make sure that if you're going to identify multiple properties, keep that number below 200%. So in our example that we talked about, that $2 million property that we sold, 200% would be $4 million. So the combination of the properties I'm looking at, keep that below $4 million. Now, if I only have three properties I'm identifying, I can identify any three properties I want. When you get to that fourth one, you got to worry about the 200% rule. All right. So that's the nitty-gritty rules on at a high level on the 1031 exchange. Now, tip number 5 is also an important item to understand. And that is that 15% of roughly of 1031 exchanges fail. So it's important to have a backup option. So what do you mean 15% fail? Well, I'm going to do everything right. I'm going to follow everything by the book. My exchange is going to go through, right? Maybe not. Often these exchanges fail for no fault of your own. So in these examples, for example, you have an investor who's gone after a property. There was multiple offers on the property and they lost the bid. So they didn't get the property that they identified. Now they have nothing to buy. Or there's not enough inventory, so you can't find something that you want to make an offer on. Or maybe you retired and you can't qualify for a loan. So in our example, 1.6 million cash, 400,000 loan. I can't qualify for the loan. I can't buy the property. The seller might have financial issues and back out. The property you want to buy can be damaged or destroyed. So let's say we dial back to when Katrina happened and you were in the process of buying a property in New Orleans and that property is now 3 feet underwater. Do you really want to buy that property? And also, this is a sad situation, but you could have the situation where the seller has, I had one where the seller went out of the country, they became injured, they were stuck in a hospital, they had a problem where they could not sign legal documents. And they had no power of attorney with someone to take over for them. Therefore, the deal fell apart. So all of these are situations that can happen that are not your fault. There's nothing you've done wrong, yet the exchange can still fail. So it's important to have backup options. In addition, not all qualified intermediaries are created equal. A good qualified intermediary will enter into a legal agreement with the investor. They'll prepare the necessary documentation to do the transfer of the property being sold and the property being bought. They control the money from the sale of the originally relinquished property. to avoid the capital gains tax. They monitor 1031 exchange identification and replacement timelines. They coordinate the details the with the real estate agents, with escrow, with the sellers, with buyers, with advisors, with whoever's involved, all with the idea that they would make the process simpler and straightforward for the investor. Now, those are the things that a good qualified intermediary will do. But a great qualified intermediary will have low cost exchanges. They'll have no hidden fees. They'll have fast, low effort setup. They'll have exceptional service, timely reminders. On the timely reminders, it would be unfortunate if you got a reminder too close to the identification period and you didn't realize that that date was closer than you thought. So it's important. Timely reminders are very important. They should have a simplified process so it's easy for the investor. They should release unused funds. So let's say you're in a 1031 exchange and on day 46, you had not identified a property. That exchange failed. That money should go to you, right? Well, some intermediaries will not release the money until day 180. It's important to know who you work with. And most importantly, your qualified intermediary should allow legal alternatives to protect an investor in a blown exchange. Now, what does that mean? Well, some qualified intermediaries limit your options. They don't let you do legal track strategies for whatever reason. It's based on the way they work. Some intermediaries are not focused on 1031 exchanges as much as they are selling you something. So their whole process is to get you into a 1031 exchange and then try to sell you something like, let's say, a Delaware statutory trust. So in that case, the QI is acting more like a salesman than they are a benefactor on your behalf. So it's very important to understand who you're working with, and it's important to work with a great qualified intermediary. So at the end of the day, what's kind of the key message, the key takeaway? Well, one is work with a great qualified intermediary, but the other is that you need an insurance policy because not all exchanges close on time. So it's important to be able to consult with someone who has a deep knowledge of the 1031 exchange and understands what the alternatives are. So here is a list of 4 alternatives I'll go into briefly that we use quite often. So one of them I mentioned before, the reverse exchange. What this does is it lets you buy your replacement property first. So let's say you own a warehouse and your warehouse, you're wanting to buy a new warehouse that's bigger. Well, you can buy the new warehouse, move your business from the old one to the new one, then sell the old one, and then take the profit from the old warehouse and use it to pay off the debt on the new one that you just purchased. So this is a case of a reverse exchange. It's a very powerful model for the right situation. That type of exchange is more expensive than a normal 1031 exchange. The average 1031 exchange is called a forward exchange. Then there's reverse exchange. Reverse exchange is probably $7,000 to $9,000 versus a $1,000 1031 exchange. There's also, I mentioned before, Delaware statutory trust. So what is that? It's essentially securitized real estate where you're becoming an incremental owner. So essentially a partial owner of an investment property that's being run by some management firm. So there's some professional management on the property. You're buying in for an incremental share of that property. And for that share, you get income and you also get depreciation. You also get appreciation of the property. There's also opportunity zone funds. These are also securitized real estate investments but they can actually completely eliminate your capital gains taxes. The downside is you have to do this over a 10-year period. Delaware statutory trust could be a much shorter investment, a 5-year, 7-year, or 10-year. But it's deferring your taxes for a Delaware statutory trust versus eliminating it with an opportunity zone fund. And then finally, there's one of our favorites, which is called a deferred sales trust. So what this does, it lets you move the assets from your relinquished property, so essentially the cash proceeds, and to put it into a cash account. And that cash account can basically earn you a return. You can invest it in stocks, bonds, mutual funds, almost anything that you can invest as a normal human being. But in addition, if down the road you decide you want to go back and buy real estate, you can still buy real estate. And in all these scenarios, it's 100% tax deferred. You can actually exit a 1031 exchange, put the money into a cash account and go invest it and retire, or you can hold it until the market improves and you go back and buy more real estate. And once again, it's still tax deferred. So these are 4 examples of items on our platform. We have 8 more. I'm not going to go into them all today, but the idea is that you have alternatives and you should have an insurance policy when you go engage in a 1031 exchange to make sure that you don't pay taxes. So a little bit of information about me. My name is Chris Shakowitz. I'm a real estate investor. I'm an investment advisor representative. I'm insurance licensed. I'm a 1031 exchange facilitator rep. And I'm a tax deferral consultant, which is why I know all of these options. So if you happen to want to start a 1031 exchange, you can work with a great exchange accommodator and you can start your exchange in 5 minutes or less. Within 12 business hours, your exchange will be live. Just click on this link at StartanExchange.com. In addition, if you want to talk about tax reduction, tax deferral, or tax elimination, you can connect with us via defertax.com, where we can reduce, defer, or eliminate your capital gains taxes or dramatically reduce your W-2 taxes. And finally, if you're an investment advisor, a financial planner, or a CPA, and you want to learn how to do what we do, we have some training materials and a course, actually an entire program, designed to help teach other financial professionals how to do the things that we do. So I want to thank you very much for your time and open it up for any questions. Thank you.